Good afternoon. Welcome once again to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, thank you for having me. Another week. We've done these for, 10, 12 weeks now?
10, and amazingly enough, we were so great with our market broadcast last week that the very next day the market dropped 6%. I'm sure that we are moving the markets with our commentaries. But it was interesting, the market was spooked initially by the rise in the coronavirus cases, but then quickly rebounded. It was almost like a head fake. So we look forward to hearing more about this from you today, Aaron, in your talk today. So take it away.
Sure. So there are no new changes to the timeline. And instead of our usual slides, we wanted to spend time on the fears of a second wave that's currently dominating the headlines, what you were talking about for that Thursday sell-off. We continue to believe that the market is less concerned about the virus and more concerned with the possible shutdowns. Our focus during this call will be the increasing COVID cases and whether a second shutdown is needed. The headlines continue to warn of that second wave, as we mentioned. Now, technically, we have not hit a second wave. Most of the states have been steadily climbing, so this is still part of that first wave, with a possible exception of Louisiana, Vermont, Wyoming. We just don't see that second wave, but we get the point. In addition, many of the states do not have high total cases. So really, they're just not working off a big number, so it's still too early to determine if this really is an issue. What is often applied, though, is the states have been irresponsible in reopening. The attention has been on Texas and Florida. These two states were among the first to reopen. Specific consideration is being given to the recent Memorial Day celebration. Remember, it's about 15 to 20 days before the cases would begin to show up. And it's really a simple and attractive narrative. But the data suggests it's far more complicated than that. The 14-day trend shows that new infections in Texas have risen about 71% in the past 2 weeks. Although confirmed infections have increased across the state, hotspots are in state prisons and meatpacking plants. Still trying to understand why they continue to show up in the meatpacking plants. But these have also been state areas where there's been mass or targeted testing, according to the Texas Department of State Health Services. So it kind of makes sense that we're seeing an increase there. And I think it's also unlikely that the prisoners were reveling in Memorial Day celebrations and participated in the reopening of the economy. So now Florida is seeing an increase, it's specifically around Miami. Georgia is increasing and opened earlier, but it does not have those sharp increases that Florida and Texas have demonstrated. However, there are certainly spikes in the number of cases that do coincide with relaxing that shutdown. But let's have a look at the states that still have restrictions. California, Oregon, and Wyoming are also seeing an increase. California was one of the earliest states to report infections, and they actually have a pretty large number, so it is statistically significant. Now, Washington and Illinois are showing decreases, and one of the thoughts is not just the reopening, but protests. Both of these states have seen large protests as well. So once again, it appears that simple narrative in the headlines has some challenges. Also, there are plenty of states that are open with decreasing numbers. So there's some caution there. Now, we have discussed the effectiveness of lockdowns in several other calls using countries as comparison. Sweden has not mandated any shutdowns. Japan has also been criticized for not restricting mobility. Yet France and Italy have had very heavy restrictions and have had higher death rates than both Japan and what was the first one? Sweden.
Yeah.
Now, often people will talk about how the older demographics in Italy and France are the cause, but remember, Japan is is the oldest country.
Right.
So that kind of puts some damper on that theory. The United States, whenever we look at restrictions, is somewhere between France and Sweden. They're not as heavy, but they're certainly mandates. So you would expect to find this the country between the two, but it actually has higher death rates than all. Brazil has been making headlines as the virus shifts towards the southern hemisphere, reinforcing that seasonality. They're moving into fall, there's cooler weather. However, if we were to go back and look at the states where we see the increase in cases, they're warmer states like Texas, Arizona, and Florida. So that kind of gives counter evidence to the idea it's about seasonality. Iran spiked early on in the beginning. And if you look at it, they may actually be experiencing that true second wave. Yet Iraq, their next door neighbor, has been much slower, and it's really just in the early stages. What is the reason for the difference? Basically, the evidence is just inconclusive at this point. Now, while testing the effectiveness of lockdowns, the Wall Street Journal reporter T.J. Rogers wrote, "We ran a simple one-variable correlation of deaths per million and days to shutdown. The correlation coefficient was 5.5%, so low that engineers would have summarized it as no correlation. I can tell you when we're building portfolios, if we saw an asset class with a correlation of 5.5%, we're going to say that's a diversifying asset. It doesn't really move whatsoever relative to the others. So there's more that the reporter said that they needed to move on to find the real cause of the problem. Now, we haven't heard back on what that real cause is. I don't think really anyone knows. Now, I think it would be helpful to revisit why we did the shutdown. Alec Bernson's recent book, kind of going through Amazon, was documenting COVID-19. Now, he snarkily reminds us the reason we locked down the United States and the rest of the world this spring was not to reduce the coronavirus infections or deaths to zero. No, the reason we initially agreed to the lockdown was to flatten the curve, which is a polite way of saying to prevent coronavirus patients from collapsing our healthcare system. He may be snarky, but the statement is true. This was the reason for the lockdown, was to slow transmission and not overwhelm the hospital. Whenever we talked about flattening that curve, the number of infections was just prolonged. It was always assumed that we would get the same amount of infections. It just wouldn't overwhelm the hospital. The initial fears were the possibility of the fatality rate being as severe as the Spanish flu. However, the CDC's latest data indicates 0.004 or 0.4% fatality rate, much lower than the Spanish flu and similar to the common flu. Now, we've referenced this chart in several other calls. Here is the current best estimate for the case fatality rate, that 0.004 that we just indicated on the previous slide. Now, in addition, the models assumed we would have overrun the hospital despite the shutdown. It simply never materialized. Now, an obvious objection is because we've done such a good job on social distancing. Well, we know that isn't true. There's been protests, whether it's against the shutdown or the recent protests. We have not done a great job, and the models assumed perfect compliance with social distancing. And even with social distancing, we were supposed to have overwhelmed the hospital system and had millions of deaths globally. The Pentagon, based on those models, deployed the USNS Comfort and the USNS Mercy in March to help the surging coronavirus case based on those models' prediction. Once again, these thankfully never materialized, and the ships were actually not really utilized, and they were recently sent back home. We will never know how much the shutdowns did or did not help. And really, instead of arguing over counterfactuals, let's look at hard data on the case fatality rate. This slide shows the daily new cases globally and the daily confirmed deaths. In April, the new daily cases begin to grow, and there's a divergence. The daily deaths begin to decline. Now, by converting this to logarithmic, we can better see this. Now, here's where the trend changes in this circle. You can see that there's only a lag between new cases and deaths. The pattern is still the same. This is because a steady climb in new cases should lead to a similar increase in deaths, just lagged. The relationship breaks down in April, indicated by those two lines. I think this is a clearer example. Once again, these two graphs should have similar patterns. So what's the reason? Why don't we see them? Well, one hypothesis would be more cases identified with that ramp up of testing. If you test more, you should get more results. However, just because you're getting more results, this does not rule out of the possibility of cases accelerating at a faster pace, right? You could still see a resurgence and get more positives because you're testing, so both can be true. The virus likely becomes weaker over time. Why? Because weaker strains can produce more infected people. How does that happen? Well, people who contract the weaker strains survive longer, meaning they don't die, and therefore have more time to spread the virus. So the weaker strains of the virus would actually transfer faster. And we do see this in most virus cases. They always show up with very high fatality rates, and over time they drop. That's one reason why that could be. Medical treatments are improving. Just the other day, the market rallied off of dexamethasone. I know I mispronounced that. I haven't heard it on the news. I've only been reading the word, so please forgive me.
That's almost as hard to say as hydrochloroquine.
It is, but we're getting better at that one. So this one is considered a breakthrough in treating the coronavirus, even those critical patients. Finally, the initial pool of sick people are likely the most susceptible, and really they're at the margin. They are immune compromised. So the deaths may cluster at the beginning. So according to Neil Ferguson, who was the principal architect for the major UK model, that Imperial College model, which was used to justify the lockdown, stated between 1/2 and 2/3 of all the people dying from COVID-19 would have died in a matter of months in the absence of the virus. So it's just bringing some of the deaths that you would have experienced forward sooner, and they would be clustering, so you would see more. And then the remaining pool would be a healthier pool, so you would see a drop. Now, the truth is, it's probably a combination of all these factors.
Right.
In addition, this list probably just is not exhaustive. There's just a lot here that we don't know, and I think 2020 has made that clear. We don't understand viruses the way that we thought we did in 2019. Now, this is not to imply the coronavirus does not carry risk. There are certainly deaths, 101,291 documented deaths by the CDC, and this is a lagged number. There are still deaths that are going through the death certificate process that have not been counted. And there is certainly an increase in deaths above the very constant weekly average. We have moved from a very stable average, somewhere between 57,000 and 58,000 deaths per week on the left, to a period with higher deaths on the right. The virus has increased the average weekly deaths. So who specifically bears these risks? The risk of death is the aged, specifically those with comorbidities. Another word I'm struggling to get, but over time I'm getting better at saying. Now this is the Italian data, and here the median age of death is over 80. Or in Minnesota, where the median age is 83.6 years of age, which, by the way, is much higher than the average median age, right? In New York, there's more than half of the deaths are age 70 or over. One of the most hardest hit in an area that the data is a little bit younger relative to the rest of the world. But the risk is not for the young. It is for those who are later in life. And since the death count is higher than other flus, and the deaths are tilted so heavily towards the aged, this means the risks are substantially higher than the common flu for those that are who are older. COVID is very much a threat. Don't take this as we can ignore it. Okay, this has been a recap of much of what we've already known and discussed before. So what is the point? Well, we are seeing cases increase in states that are not in the Northeast. COVID is certainly not yet over. And there is little to no correlation of the virus outbreak and the shutdowns. In addition, there is likely a lack of political will to do the shutdowns again. And the shutdowns, not the virus, are the cause of the market sell-offs. This is, or what we believe, I don't want to say that as definitive. This is why the market has sold off and then has recovered, because it's realized the political will isn't there to shut down. To conclude, stay invested, and especially if you're in that risk group or provide care for someone that's in that risk group, practice great caution. Now, let's move on to what we're seeing in the economy. Last week was a very quiet week. There was little change, but we still had a slightly negative report from the week before. Nonetheless, we believe the bottom of economic data is in. We are starting that long climb up back to recovery. There we go. Now, with the lack of economic activity, but increases in unemployment benefits, where many are making more than before, there was a substantial jump in the personal savings rate, above 30%. John, can you imagine that? Americans saved above 30% as a personal savings rate.
Boy, they're falling into our philosophy of trying to help people become and remain financially self-reliant. Let's see how long we can keep this going for them.
Yes, but most likely this will turn into pent-up demand, where people begin to see that, and we possibly saw that yesterday. A 17.7% headline gain in retail sales, and this topped the record 6.7% for October in 2001. Do you remember President Bush saying, "Get out there and spend money,
Oh, yes.
go shopping"? And the American people answered at 6.7. That was the biggest on record. Well, 17.7 is much higher. And the economists were estimating an 8% increase. So this is more than double. Where was it? Clothing and accessory stores reported the biggest percentage gain at 188%, while sporting goods, hobbies, musical instruments, and bookstores rose 88.2%. Now, much of the above are used in homes. As an example, it is difficult to find home gym equipment because so many people are building home gyms. Now, speaking of homes, Home Builder Sentiment posted the biggest monthly surge ever, adding 21 points to reach 58 on the index. Anything above 50 is considered very positive. Now, listeners may recall we recently added the Home Builders ETF in exchange for gold, based on our technical analysis. We started to see in technical analysis money flowing to this well before this report. Now, after the stay-at-home orders, many are likely budgeting more to their homes. We also anticipate a move away from large cities and towards the suburbs. Now, we have anticipated a V-shaped recovery and have been long equities because of the stunning monetary policy. We've been advocating or believing in a V-shaped recovery is the most likely scenario since we've been doing these calls. And this still continues to be the case. Money supply growth is now at an annualized pace of 52.1%. That doesn't mean that we've increased it by 52%. That means it's growing if you were to annualize it at a 52%. This really is the reason for our inflation worries. Now, what can offset that? Well, that personal savings rate. If Americans decide that they don't want to spend all of that 30% and they want to really build up a cash buffer, or they want to add to portfolios, that could detract for some of those inflation worries. But the money is certainly there, and it's certainly making its way into the economy. Now, moving on to the way that the market is behaving. As you mentioned, we had that sharp sell-off last week with initial fears of hotspots, but those quickly faded as politicians, really on both sides, say a shutdown is not likely for many of the reasons that we just talked about, and then the political reasons. Do we want additional protests and pushback? Probably not. A governor certainly doesn't want to be ignored. They're more likely to put out guidelines than they are to shut down again. Now, what is instructive is how that market moved. We have not added any lines to this week's price point chart. These are all the same lines for last week. Yet the market traded in line with these price points, or those lines. Many market traders are watching the technicals and acting on them. And this makes sense, considering the monetary policy really is to divorce the market from fundamentals. Everyone's saying, well, the fundamentals don't justify this price. Well, it doesn't matter. That was the point of the Fed doing their monetary policy. So all caps, do not short this market, because the Fed has anyone that wants to be long the market, they're going to have their back. It's not a coincidence that Chairman Powell came out after a 200-point drop and said the Fed is going to continue to act. They're going to continue to provide any assistance to the market to keep it elevated. Now, we've finished many of the trades last week in qualified accounts to favor that U.S. domestic tilt that we had been talking about, meaning that we added small and mid-cap exposure from that large cap, specifically our significant overweight from technology. The S&P, when we're looking at the relative strength, is near the bottom ranking. Now, once again, we increased that small and mid-cap, but we still hold an overweight to technology, and these really are all the sectors that are at the top of the table. International is also ranked higher than the S&P 500. Through most of the time, the S&P, over the last several years, the S&P has been at the very top of this table. It's the first in a while that we've seen it near the bottom, and to see international above the S&P 500 is something we want to pay attention to. Remember, we favor U.S. domestic. And in qualified accounts, we did swap our international fund for the small cap world fund. Now, it has exposure to U.S. small cap, but it also has international small cap. And if you look at this table, I know that everyone is not familiar with the different names on here, but know that this small cap international is doing better than the large cap international. So we feel we're well positioned at the moment with our technology, mid cap, small cap weight, and those changes in international. Now, with an overweight to U.S. domestic market, we are certainly watching the strength of the dollar relative to other currencies, and the dollar has dropped precipitously, but it is actually up for the week. So we will continue to monitor that. John, I'm going to turn it back over to you for questions and answers.
That'll be great. Well, thanks, Aaron. I mean, as usual, your presentation is excellent, relevant, and timely, and we have had a number of interesting questions come in today from our listeners. So one of the questions came about with regards to a Wall Street Journal article that appeared Monday, in which it said that more than 1/3 of investors above age 65 dumped all their stocks sometime between February and May. Can you comment on this, and what would we recommend at this point for these investors?
Well, you never know when another market correction is going to happen, but this just shows, despite the volatility, you're better off to just stay in the market. So equities are going to outproduce bonds over the long term. That's priced in. So how do you get a higher return that's almost assured? Nothing's guaranteed, but it's almost assured over the long term that equities are going to outperform bonds. Where does that come through? Well, the price that you have to pay is that volatility. Yes, a lot of people do abandon, and whether your advisor is actually beating its benchmarks or not, if they can keep you invested during those times, whether it's a 2008, a 2011, a 2018, or a 2020, that's where advisors really help and remind you what your long-term goals are, how well you're tracking despite a correction, and help really control those emotions so that we don't make those costly mistakes, and they are costly long-term. The average investor, whenever you're looking at the data, let's say on Fidelity or Schwab or any of the discount brokers where it's really retail investors, end up getting less than inflation because they get in and out at the wrong times.
I mean, that's a pretty remarkable number. And the study was done by Fidelity, but that large of a percentage of stocks for people over age 65 abandoning their strategy all at once is pretty remarkable. Now, there's also been talk about Congress enacting a return to work bonus as a way to incentivize people off of unemployment and into employment. Can you comment on this?
Well, I'm a big advocate of reducing the spending of the government, but I think this is a correct way, at least on a real politics standpoint. The unemployment benefits are very generous, and it was basically the government telling people they couldn't go to work. So there's a lot of reasons why that is probably the appropriate thing. It's not like these companies were doing anything incorrectly in their behavior or their risk taking should be punished by the market. The government simply said you had to close. So then they responded with very generous unemployment benefits. The unintended consequence of that is, well, people are making more money than they were, so they're less likely to go back and be employed. So one thought is to extend the benefits past July, but that doesn't solve the problem. You'll never be able to lower unemployment rates and then remove that if you're paying people more than if them going back to employment. So having a bonus for for going back to work, so you're not punishing, because that's essentially what you would be doing by removing money that they were making, giving them a financial incentive is probably the right thing to do. Is that the pure free market response? Absolutely not.
No, but it'll be interesting to see how it does respond as soon as that goes through. So another thing you had talked about is the issue of the dollar dropping in value. In fact, today, the Wall Street Journal reported that Stephen Roach, Yale University senior fellow and former Morgan Stanley Asia chairman, has a warning for U.S. dollar bulls. The prominent economist says that the era of the U.S. buck may be coming to an end and is forecasting a 35% decline soon in the U.S. currency against its major rivals, citing increases in the nation's deficit and dwindling savings. Can you comment on this?
Well, yes, that's possible. We certainly have concerns. It's one of the reasons that we are watching the dollar. But that assumes that everyone else's house is in order too. Where are you going to go? Now, what is true when we look at the money supply numbers in the Eurozone is they're up about 10% annualized, while the U.S. is up about 50% annualized. So we are creating more money or more U.S. dollars than other currencies. But that was intended. And if you think of what the current administration has talked about is how other people are manipulating their currency and they're devaluing their currency to remain competitive. So the U.S. in turn is doing similar things. Yes, that should lower the dollar in value, but that ends up making the goods that the U.S. Produces more attractive, and they can sell more. So it's not just, it's far more complex. Could this economist be correct? Yes, there's plenty of things that you can point to that make the argument that could be the case. Certainly could be the case, certainly something that we're going to be watching. But once again, there are a lot of other currencies, and is any one of those currencies really going to gain that much against the dollar? What's the bullish case there? And I see everyone holding very large debt issuance relative to their
right. But I think that's the primary issue there, is that he's saying that it's the nation's deficit, right, and dwindling savings. Well, that's an issue with every country out there. The sovereign debt has just exploded everywhere.
And yes, the savings rate is higher in China, but their strategy right now is try to increase consumption domestically. So that means their savings rate would begin to decrease.
Now, you've also seen in the news that there's tension building between North and South Korea.
Yes.
So what impact might an escalation in this conflict from a global economic standpoint be?
I think it really depends on how the U.S. responds. If we get into any conflict, which is, there's a lot going on in the world. And it's probably not a coincidence that the U.S. is dealing with a lot of domestic issues, and North Korea it has put some pressure on, so it could be where military conflict is there, and that would be another inflationary component, because then usually whenever you're having military movements of this size, there's a lot of energy that is used, and there's a lot of material that is demanded. So that would cause a lot of inflationary response within the economy. Hopefully cooler heads prevail. And South Korea is not an insignificant country, but they also are, I won't get into stories from the Marine Corps on South Koreans have a very strong and capable military.
Well, I know that it's interesting because all the news on the coronavirus, and then we had all the news on the protests, it's really drowned out a lot of the things that are going on globally,
Yes.
which is something that we do need to make sure that we're paying attention to, because there's another area, there's tension growing in the Kashmir province between India and China. So what are your thoughts on that potential conflict?
That's always heated on who actually has what territorial control, and from what we can tell, early there was reports of 3 Indian soldiers' deaths. Turned out to be more because there was a firefight, and it was 20 other soldiers were shot, and it's very cold, and they were not able to get medical attention. So this is not just a skirmish of people throwing rocks back and forth or fist fighting. Happens all the time here at that border, as well as what actually happened to the Chinese troops. They have not responded with any that I know of any injuries or any deaths, but we would assume that probably is likely. So these are 2 very large militaries that have a lot of animosity towards each other, and it's certainly of significance. And they both have nuclear power. So
You know, it's interesting. So another thing from an international standpoint, you were talking about lockdowns, are they effective or not effective, is that COVID cases keep re-emerging in China, and they respond with lockdowns once again, because they just had the another wet market, meat market that was where they had the new cases.
saying so salmon meat.
Right. So can you comment on that?
Yeah, I think this just goes to show that China, relative to all other countries, are probably the heaviest lockdown, right? And they were able to control it through their lockdown. They were able to remove it. As they relax, they have a resurgence of it, right? So then they never hit herd immunity, and though they may be able to do a heavy lockdown again, they have no control of other countries, and the virus doesn't respect any borders. So it probably is fairly futile to try to stop this through lockdowns, because even if as a country you do it well, you're still dependent upon every other country doing it as too, because the moment you open and other countries that still have the virus are going to come back in. These viruses, it's probably best to just try to figure out how to really protect those that are at the highest risk and try to achieve herd immunity, where all the young people are able to go out and actually contract it through their normal things and keep them separated for those that are most susceptible, so we can get that 75 to 80% immunity in the people that are low risk, while sheltering the people that are at high risk, so that we can get that herd immunity and move on with our lives.
Well, I think if there's one takeaway just from listening to all the things that you've been describing, is the fact that it's the elderly, especially those that are immunocompromised, that are the ones that are the greatest risk. I mean, even you look at how many of these nursing homes, they were just rampant spread of the virus, and then multiple deaths. If we had done a better job at protecting them. So the virus is going to make its way through the system, but I think that's really our responsibility to our citizens, is making sure that we're taking care of those people most importantly. But now one of our listeners said that he had planned to seize the opportunity of investing when we were at the market lows back in March and April. But he missed the opportunity because of his own indecision. And now he says, well, why don't I just go out and leverage my portfolio to raise additional cash to invest in the market? What are your thoughts there?
Well, essentially you're shorting bonds, and we're not very bullish on bonds. So is it risky? Yes, you can certainly get margin calls, so you got to talk to your lead advisor on this and know that there is risk that goes with it. But buying on margin and going long this market, especially with the idea that the Fed will likely continue to step in, I think you can make an argument that will work out well. But the thing that I would really, really highly recommend, as we always do, is you have to have cash in case this goes against you and you need to pay back that loan and prevent any forced sale. The market will continue to go up at some point, and it's just that momentary point in time that
Never want to be in a position where you have to sell at the wrong time.
Right, you don't, exactly. Yes, with the caveat that I need to know a lot more detail on whether that's appropriate or not. That is a strategy that actually I am employing in my portfolio.
So it's interesting, we were talking about, we just experienced the largest increase in retail sales ever in history in a single month. Yet at the same time, we're having an enormous number of small retailers filing for bankruptcy. That number is increasing week after week after week, and it just seems so disheartening. How do we balance those two or consider those two factors? Because it's in the same sector, right? But you have a positive influence and then you have a negative influence.
Well, there's just a change in the way retail is being done, and this has only accelerated that. Amazon and Shopify, there's a lot of services that deliver packages to your home. And do you need to continue to carry the expense of brick and mortar? Well, certainly if you're PetSmart, I don't think we're going to be shipping heavy dog food bags anytime soon. But I think this has accelerated that long trend of moving towards the Amazons and the Shopify. And you can see this in Walmart too, right? They're building out their internet shopping and retail, because that's where most of the retail purchases are happening. I actually, now this is not an investment recommendation, but think Walmart, if they were able to respond well and figure this out, may actually have an advantage over Amazon, because they have stores locally, and their distribution centers could actually deliver those packages same day, where that's been a goal of Amazon for quite some time. So we just see that continuation. Whenever you get consolidation in the market, it is unfortunate that many small businesses are the least equipped to compete as there's a consolidation, and that seems to be going on in the retail space.
You know, you've been talking the last few months on the pandemic and thinking about where we are now. We've got this V-shaped recovery. What are the things that concern you the most about the economy and the market at this juncture in the pandemic?
Inflation fears, and how do we deal with them if they do start to reoccur? As you had mentioned, there's an enormous amount of debt at the national level, and we are on what I call the mother of all arms. Most of that debt that the government has issued as short-term paper. Unlike the Volcker years, whenever we let interest rates rise to 20% to fend off inflation and save the dollar, we don't have that ability. So getting back to the one concern of a 35% drop in the dollar, that's the thing that keeps me up at night is, do we actually get inflation? And if we do, how do we stop it? Because it's not, I don't see a very clear, easy answer on how to stop that.
One of the questions that came in says that Apple announced that they are facilitating over 500 billion transactions each year. This was last week. They continue to dominate the smartphone market and reach $1.5 trillion in market cap. Is there a reason why we may not have them in our portfolios?
Yeah, there's when we buy individual stocks, we're looking for wide moat stocks, and we let Morningstar make that determination of what competitive advantage Apple has, and they have not given them a wide moat on their phones. So that's prevented us from adding it into the wide moat stock portfolio. Now it has done tremendously well. Another name that's done tremendously well that we don't own and probably wouldn't own is Tesla. Now there's plenty of stocks that we do own that have done phenomenal, Google, Amazon, and some other big names that have appreciated very nicely. So Yes, we would love to go back and buy Apple, but we want to stick to that process and look for companies that have a competitive advantage, that when we purchase them are trading below their fair value with a margin of safety on the purchase, and are technically positive. We've seen the technically positive for Apple. We have not seen that competitive advantage.
Well, it's interesting because, so many of these companies, when you look at them in the rearview mirror, look awesome, but we have to stay true to what our trading principles are. Otherwise, we're putting ourselves at risk and our clients at risk, and maybe not having the performance that we really should be having. Another question came in was, how many of your clients went to 100% cash during the bear market?
Very little. One of the reasons I think that we were able to help clients not make that decision is the call that we're on right now, being able to get information out there to help process and understand what's going on there, what is the actual risk, and to just bring some of the things that we're looking at to give them more comfort. So were there clients that did move to cash? Yes, there were a couple, and hindsight's 20/20, but making that change did hurt investment portfolios or their performance going forward. There were far more clients that did take the advice of leaning a little bit further into the market, and the lead advisors did reach out to those individuals that had whenever they looked at the plan, had that ability, that capacity to take additional risk at that time. It wasn't appropriate for everyone. We were monitoring that, and there were far more people that ended up adding risk, and we have since taken that off just because the market is no longer significantly undervalued. As we said, it's kind of divorced from the fundamentals yet.
Well, it's interesting because we had many people in the very beginning wondering, boy, should I be moving to cash? Should I be becoming more defensive? And I think the fact that everything was so unknown at the time, of course, now we look back and say, well, of course, this is an easy decision. It was a very difficult decision for everything that the investment committee did, because it's very emotional when you see things dropping, especially as fast as they did. So even though we did better, seeing the market go down is scary, and that's why the advisor helping clients manage through those emotions is just priceless.
Right.
So one last question I have is, I want to ask you about your crystal ball, because I understand you've described it as being cloudy, but earlier you said, and I know it was from a couple of days ago, that the overall market was down almost 11%. So now we're looking towards the end of the year, so we've had a good recovery from where we were. What do you think will happen between now and the end of the year, and what are the factors that would determine whether you would think differently than what you would think now?
So I think we're going to continue to be surprised on how fast and robust this recovery is. Like mentioned earlier, the economists that were surveyed assumed an 8.8% jump in retail sales, and it wasn't 10, it wasn't 12, it was 17.7%. And these are smart guys. So it's continually been a surprise to the upside. Think of the ADP payroll a couple of weeks ago, where it was several million people added back to the payroll that was completely unexpected. So if this money supply growth continues the way that it has been, I expect the recovery to be very fast, and that we will be hitting new highs. What would cause me to say otherwise would be the Fed beginning to pull back substantially on the amount of money and the accommodation that they are going to be providing to the market. I don't see them doing that until we actually start to see the whites of the eyes in inflation. I think they want to run this until they feel like they have momentum behind them, and we're hearing that whenever Chairman Powell is talking. He's very much jawboning the market, saying that they will provide whatever liquidity is necessary. I wonder just how much price discovery, if any, is being done in the bond markets. One of the reasons that we want to really kind of lighten the load relative to risk profiles and not hold as much bonds as previously because of just what's going on there.
Right. Well, Aaron, it looks like we're out of time, and I want to remind you that this weekend is solstice, the summer solstice, so we'll have the longest day, and it's also going to be Father's Day. So I hope that you enjoy your Father's Day with your son.
It is 20th. Okay.
So hopefully he'll remember. So if you don't remember, hopefully I will remember for you. But I also want to remind our listeners that any commentary about any individual stock is not an endorsement to buy or sell. These are simply informational commentary, and it's up to each individual investor's personal choice as to whether or not they would want to buy or sell any of those securities. I also want to remind you that these weekly broadcasts are open to the public. We do have a new advertisement that can be forwarded through your social media that invites your friends and the general public in to listen in, because we want to make this available for people that want to remain informed and have good action items that they can take away. So we, as I said earlier, are on a mission to share our expertise with families, helping them become and remain financially self-reliant so they can give purpose to their money. Because we believe that when we help families grow and maintain their wealth, we actually help society. So thanks again to all of our listeners. Thanks to you, Aaron. Have a great rest of the week, and we'll see you next week.